Good morning and welcome to our weekly update of the Ashworth Wealth Weekly Market Update. Thank you for joining us today, and we have a little bit of interesting things to unpack this week. Last week was a big week for the financial markets, and with the bank failures with Silicon Valley Bank, and just trying to find out where everything is at with that, we're going to move forward and talk about a few things with regards to that, and also with the economy, with inflation. We're going to throw in one more slide today, so this presentation may be just a touch longer than normal, but not by much. So with that, we'll go ahead and jump in and take a look at where we're at. So one of the things that I want to just kind of show you here for just a minute is that with regards to the banking system is not equally weighted across all of the equity classes. And so depending upon where your portfolios are, depending upon how aggressive you've been, depending upon various other things, you can see that the various indexes have a lot different weighting within their organizations or within their indexes that they're looking at. And you'll have to excuse me for this time. I've got a few notes that I'm going to be reading from today just to make sure that I'm getting everything said that I want to get across today. So you'll have to forgive me for that today. But what you'll notice here in this chart is that the S&P 500, which are the largest 500 stocks in the US, the largest equity stocks, really only have 3.3% of their total index weighted in financials or in bank stocks. You can see that in financials in general, they're 10.5%, but as far as the actual bank stocks that are in them, it's only 3%. You'll notice that the Russell 2000, so the Russell 2000 expands down to the small cap index and includes everything that the S&P 500 does, but it goes clear down to the largest 2,000 companies and gets down into the small cap index, both value as well as growth within that index when you're just dealing with the Russell 2000. And you can see there that the financials as a percent are 18.5. The banking sectors within that index of the financials is only 9.5%. So a fairly much higher weighting with small caps than there are in the large cap stocks. If you're looking at Russell value, there's 23% of their index that is represented in financials, with 6.8% actually being represented in banking stocks. And the Russell 1000 growth barely has, it has less than anybody. Again, small cap growth. The banking industry typically isn't known as a growth type of stock. And so as we go through this, depending upon where you're invested and depending upon what your portfolio looks like, you will have a lot different outcome from depending upon where you're at. For example, the S&P 500 last week was up 1.5%. And the Russell 2000 was down 2.6% last week. And so we've got a little bit of disparity there. And mostly that is just coming from very specifically those bank stocks. In the small caps, larger exposure to financials at 18.5% compared to large cap at 10. Interesting thing is that with financials, banks account for most of the small caps weighting. In fact, over 86% of the financials are represented by bank stocks in the small cap, whereas in the large caps, that's just not the case. So when it's coming to style, what we're seeing is a little bit of a, anyway, this is something that the market does with some regularity, is that when there's a little bit of a hiccup or a crisis in the market is always looking for safe havens and where they can go to possibly avoid some of the downturns that are going on in the marketplace. Interestingly enough, the large cap growth, specifically, those are your Googles and your Netflix and those type of companies, did really well last week, despite, and they're actually being used now as a little bit of a hedge against the financial sector. And so again, these are just normal market cycles, and they're just going forward the way that markets do when we have this type of an event. It looks like that the banking crisis is going to be contained. We don't see any long-term effects from this other than just the fact that there's going to be some restructuring and some cross currents creating normal volatility in the marketplace, but we just don't see this as something that long-term by the end of the year isn't going to be worked out. Credit Suisse looks like it's being bought out by UBS. Credit Suisse has been on kind of on first aid for the last probably 3 to 4 years. So even though the financial crisis has kind of exposed them a little bit more than possibly what they have been in the past, it's not like Credit Suisse hasn't had some problems, very well-known problems over the last 5 years. And so having them bought out by a larger bank is probably a very good thing, and going forward. We're going to go to another slide here, and I want to just talk about, again, for just inflation and interest rates rising and where things are going. You can see here by this chart that we are in tighter financial conditions, but as far as the market is concerned, we've actually had a little bit looser conditions. You can see over here on this that we've actually gone up a little bit as far as so a lessening of the tightening of financial conditions. And so as we go forward, a couple of things that are coming to light here. And again, this is where I want to read just a little bit. And so what we're looking at here is that there are many different sectors that go into the inflation rate. And as the Fed is trying to unpack all of this, one of the things that's happening is that there have been many data points that have been pointing to the fact that the Fed, even within the last 2 weeks, has told, they testified to Congress that they were going to have to continue to increase interest rates, continuing on possibly a more aggressive scale than what they had initially thought. But what has happened now with the fallout with the banks is that they're seeing that there are segments of the economy that are being hit really hard by these increasing interest rates, and primarily due to the fact that they've been increasing so quickly. It just hasn't allowed the financial system to absorb these rate hikes in a manner that has been prudent. And so we're seeing stresses in certain parts of the economy. We're seeing other parts of the economy that are still really strong. But I want to kind of go through a little bit of stats here and show you some things that maybe talk through some things. So shelter, which is a 70% of the CPI. So that's housing, it's rents, it's how much your home mortgage is, and all of those types of things. 70% of the CPI is governed by housing. And so it's a huge impact on what's happening. With the latest inflation data that came in, the inflation data was quite hot, is what the economists are calling it. Year over year, it increased about 6%. Core inflation increased about 5.5%. But again, unpacking that, 70% of that is coming specifically from housing. And the interesting thing about housing is that housing is a real lagging indicator. In other words, it takes a while before the slowing of the economy will show up in the housing market, just because there's such a demand for it. And so what happens with this is that if you have a housing market that's lagging everything else, and you're trying to get the housing cost more in line from an inflation standpoint, and everything else is suffering possibly more dramatically than housing is based upon the increased interest rates, those things need to be taken into consideration. And the interesting thing is that without housing, in the expectation for inflation, there's a survey that New York did. Anyway, they do on a regular basis of consumer expectations of inflation. It's currently at 4.2%. It's the lowest that it's been since May of 2021. So that's coming down. Wages says average hourly earnings increased a modest 0.2% in February. says not only has wage growth slowed, but CPI has outpaced it for 23 months, meaning inflation has outpaced the growth of wages for the last 23 months, which is basically eroding consumer purchasing power. Financial conditions, it says financial conditions have tightened significantly over the last few days, reflecting market turbulence and a higher cost of capital. The Bloomberg Financial Conditions Index nearly matched peak tightness from September 2022. So what's happening is this. Number one, the Fed is trying to get inflation under control. The way that they do that is by making money less available. In essence, what they're doing is raising the cost of goods and services, or reducing the amount of money that people have to buy goods and services, so that there's not such a demand on those that it keeps pushing up inflation. The way that they do that is by pulling money out of the economy, and that's done through raising of interest rates. It's like this big pool of water, and raising interest rate just acts like a sponge and just pulls the water from the lake, and so the lake lowers. Thus, people have less cash to buy things with, and it ends up lowering inflation. So our overall look at the market, at conditions, number one, we feel like that the banking system is a short-term thing. We feel like it will be worked out. The government backing that has been put in place should resolve most of those issues. Inflation looks like that it is beginning to break, and we feel like that the Fed, more than likely, as what most people are saying, and we'll keep track of this and kind of keep track of where things are at and the feelings and the sentiment. But the feelings is that they may have to back off some of the raising of interest rates that they wanted to do, just because of the turbulence that are going on in the various sectors of the economy right now. If that happens, you're going to see the market return to a more normal state. You'll see values come back again. And so we just feel like that this year there is going to continue to be those turbulence. We've talked about ongoing volatility, but we do feel like that by the end of the year, a lot of these things that currently are cross currents in the economy are going to work their way through the economy. We'll have a better idea on it, and what the market likes is a little bit more certainty. Once we get a little bit more certainty, the market will return back to a more normal type of a volatile state, and hopefully we'll get some good returns by the end of the year. So with that, we'll go ahead and close for today. Thank you so much for watching. If you have friends or family or coworkers or associates that you would like to forward this link to, you're welcome to do that. We are trying to do this on a regular basis just to keep everybody in the loop as far as what's happening, and maybe give an outside opinion of things that we're seeing that are going on in the market. Thank you so much for joining us. We appreciate it very much. And with that, we will see you next week. Thank you so much.